Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? We're going to do something a little bit different. I was just kind of looking around for ideas. I was kind of playing with some of the things here, looking for a video idea, and I thought, I wonder what the best performing mutual funds are year to date. So I put together kind of a lot of stuff, but hey, we're going to go over it, see what you think. We did international funds a while back, actually I think 2 weeks ago. But what I'll do is just take you through the best performing funds so far and show you some of the things that stick out to us. We're not mutual fund pickers here. For our clients, we actually build our own funds. You can think of them as their own little mutual funds, and the performance and everything is on our website. We're one of the only advisors that does that, by the way, and actually publishes how we're doing and the various different funds. So I hope you'll check that out. But hey, let's dive in. I can't go through all the different classes of funds. Maybe we can expand on this if you find this interesting. But what I'm going to start with is the growth funds, right? So real simply, just go over to sort of a scan that I did here. We've got the large growth funds out there. There's 1,366 of them. And rather than just say, oh, this was the best performer and look how well they did, I wanted to add something to it for you guys. So here's what we got. Best performing funds, you can see ranked year to date, by the way. That's true. 84% for this one. We'll cover that one. We'll cover the top 3, which is actually this one. So before I go on too, if you see that they're the same fund with different ticker symbols, those are different classes of funds offered under different plans. So they're basically the same. They're just different classes. So we're not going to go through all Morgan Stanley funds. And Morgan Stanley did not take 2nd, 3rd, 4th, and 5th place. Anyways, year-to-date returns, there's going to be a huge difference there and some comparables we can look at. I put the expense ratio on there because a lot of people like to look for the cheapest funds out there. I'd like to make a point that it's better to pay up for performance today. As you can kind of see, some of these are rather pricey. And then we took a look to see how much money is flowing into the fund versus out of the fund. A negative number would mean that money is flowing out of the fund. A positive number would obviously mean more people are buying it. So for example, the Morgan Stanley fund down here had about $666 million come into it over the last month, over the last 3 months, you could see, and then over year to date, it's actually gained 1.3 billion in new funds. That's not appreciation, that's new dollars committed to the fund, so they're doing well there. Anyways, just wanted to point that out. Now, the winner, and by the way, you're not going to see Vanguard on this list, by the way. Vanguard is the 136th best performing growth fund. Their growth fund, their large cap growth fund, VWUSX, is the 136th fund. It's the cheapest, but it's the 136th best performer. So, anyways, first one here, GSOFX. This is a GMO Special Opportunities. That doesn't mean a whole lot to you, does it? Let's go over and take a look. So these guys rather pricey, right? 1.22% expense ratio. That's total. Dividend yield basically gets eaten up by the expense ratio. Got a small front load there if you're going to start with smaller amounts. The idea behind this fund is it's smaller and they're able to make discretionary decisions as to what they want to do. In other words, the fund managers down here, Malcolm and Tariq, can do whatever they want, right? Basically, within reason, within the prospectus, but they can do whatever they want there. So if we take a look at this fund, currently, it's mostly made up of Carvana, Wayfair, right? They make up 30% of these two. Carvana's up 40% year to date. I just know, I just looking at it. Wayfair, I don't know if you've seen Wayfair, it's up 130%, at least as of the time I'm recording this. So they got a bulk of their investments in a couple stocks. You would argue that this is diverse. There's 20 stocks in the portfolio. I'm sorry, there's 16 stocks in the portfolio. They've got cash. They actually have, where are they at? Cash-wise, they've got it's 12% cash that they're sitting on in total. So the first thing here, you go back to this when you say, holy cow, 84% just this year. Ask yourself, not just that. You say, well, I'll pay the 1.22%. Ask yourself what type of volatility you have to expect to participate in that. And if I go back here just for just a second, max drawdown, 54%. So when they're volatile on the downside, you're going to play along with it. I'll highlight that here in just a second. But that's just kind of what I wanted to share with that one. Obviously, they're well above this, doing really well. Active fund, right? So this is not a passive fund. And the idea here is, as you look through the list, the smaller funds perform better. Why is that? This is a stock picker's market. A stock picker's market is referred to as someone is literally picking stocks, right? Instead of just going with the flow, going with the index, you pick stocks. There are windows of time where if you're a stock picker, you're going to outperform. It's not all the time. Passive funds do win it at times as well. But this is an active fund or an active stock picking type market, as I've highlighted before. Now, if you have $25 billion as the, where's my, who was it there? Morgan Stanley? No. Let's go down here. So if you got Morgan Stanley, you got $12 billion to move versus the top performing one, $276 million. What do you think is easier? Probably a couple clicks of a button, you can move that kind of money around if they wanted to. But $12 billion doesn't move around as easily. They still did well. You can see this fund is obviously performing quite well. But you get the idea. Smaller funds that are able to buy, and be a little more nimble are the leaders here. Okay, anyways, let's go on. So the second place here, you got Morgan Stanley Insight Fund. If you're curious about this one, basically, they're looking for common stock in general, but large cap type companies. The large cap fund, they have I would argue, a wider explanation of what that means. But anyways, a little bit cheaper here. Max drawdown, by the way, you see that? That's over history, the max over whenever this was. This is an older fund, so they've been through a lot more than the GSOFX. They're only 6 years old, actually. So anyways, Morgan Stanley doing well here. Obviously very volatile. You can see during the virus decline there, it basically performed in line with the market, so that's kind of good news there. We'll have to maybe dig a little deeper on this 84%. And then if we go over to we'll call it third place is Zevenbergen. I've actually never looked at these guys, which was kind of interesting. 1% expense ratio, smaller fund, $58 million bucks. And let's try one thing. Can you hang with me for a second? Years since inception. I want to add something real quick. There you go. I wanted to show how this was a new one here. So this is going to be a little bit, you're going to get thrown off a little bit. So 6 years old, which we mentioned for GMO. This stock, or these two funds here being around, well, this one for 1 year, it's a class of stock. The fund itself's been around 22 years, but this class offering has actually only been around for a year. So don't let that throw you off. It's the same thing. It's the same performance across the board, basically, minus the fees. Okay, so then this Zevenbergen, or whatever you call it, 5 years, younger stock, or younger ETF. So these guys basically have the world available to them. They can invest in IPOs. They can invest in anything that they think is under, it's not a value fund, but anything that's trading at a discount that's got growth potential there. They've got a lot to work with. Max drawdown 35%. That's very interesting to see around this time from the virus decline there. And so those are your top three. Notice you guys have probably never even heard of Zevenbergen. I had to look them up. GMO, I know, is one probably most people haven't heard about. But let's take a look. So the most important thing, I think, the takeaway here, here's GMO compared to the S&P. It's not really fair to compare it to the S&P. That's not what they're trying to do. These guys are trying to beat, and they have. But here you go for that one. This is year to date. I encourage you to look further back if you're going to follow performance. Your second place performer there, the Morgan Stanley Fund, not quite as good, but obviously a nice return. Look here. This is the real exciting part. Returns are one thing. Yeah, if you have it, you did well. Okay. But look here, the GMO fund, you had to sit through that 50% drawdown. Remember, we looked at that. So the volatility, if you want this type of return, it comes with volatility on the downside. You've got to be ready for that. If you did not know that about this fund and you bought it in your 401k or something like that, you might have got, 50% decline. You might have got a little nervous. I wouldn't blame him for doing that. And then your Zevenbergen, Zevenbergen was less volatile as well. This, I would argue, if you could count on these returns as an average or something close to it, I would argue that these two stick out a little bit better for most investors. You'd rather have a great return with very little volatility compared to the more volatile stocks that have just a little bit better return. Some of you will just say, give me the returns, and that's your thing there if you want to take a look at that. Okay, keep in mind, this is just year to date. I was just bombing around here, just looking at some different things, thought I'd check that out there. These are also active funds. If it's something you want to research or dig a little bit deeper. And I don't know, for those of you, that's basically what I wanted to cover in the video. Those of you that want to stick around, I'm going to run over to target date funds. And just for fun, I want to show you the difference in these target date funds. We're going to go to 2030. You could really go anywhere here, but check this out here. 2030 target date funds. These are, all target date funds are not the same. Not even close. Right? For example, Vanguard, great target date fund, but they play on the side of caution, right? So they're never going to be the most aggressive target date fund out there. And because of that, a lot of our customers that say, hey, I want a target date fund in my 401k, but I'd like to be more aggressive, we've got to get a little creative there. So just know that. Taking a look at the target date funds, Manning gets top place here so far, year to date, 6%. And look how performance drops off so quickly. These target date funds, you would say down here, oh, these aren't as good. American funds, John Hancock, Dimensional, if you own those in your 401ks, 403bs, whatever, State Street, you would look at this and go, oh, those aren't that good. Actually, that's really good, right? These funds are basically performing in line. As you start working your way down here, your TIAA CREFs, your Fidelities, your Vanguards, Putnam, things like that, they're underperforming a little bit if you were to compare them all and put them all in a room and say who's the best target date fund managers or whatever they are. I would argue that, some of these are not as good. Fidelity Freedom funds are very tricky, by the way. If you're looking at target date funds, you got to be careful with those. You don't just pick the Fidelity Freedom fund and run away and think that everything's good. Big difference there. Anyways, also volatility. This is the standard deviation of the returns. It's not looking back all that far, so it's going to be a lower number. But basically, for the higher returns, you've got to accept more volatility, right? If you come down here, if you're going to accept average returns, which is this is about average, basically the flat line, you don't want to find yourself in an American funds ETF. Notice how these funds, in order to achieve the same average return as other funds like John Hancock, State Street, Fidelity, Columbia, etc., they have to take more risk, meaning they're a little more wild and sort of riding a Bronco just to get down the street versus just kind of riding on a scooter, right? So a big difference there. That's the kind of thing you want to check out overall. Also, American funds, they tend to be a little pricey. Some of these are going to have front loads in them. Any of them that have an A are going to have front loads and are probably not something you want to play with, but they're going to be a little more pricey. They are bigger, right? It's a bigger company, but more volatility. I'll take more volatility if it means a substantial increase in returns, but I won't take more volatility down here. Like, for example, looking at Fidelity Freedom funds, I told you these are tricky. I'm not going to take below average returns as compared to the other 245 target date funds if it means I'm taking higher volatility risk. So remember, we've talked about that. You guys know, all right? You know what we're talking about there. Hey, anyways, I'll wrap it up there. I didn't mean to take a lot of your time today. I was just sort of scanning. I thought this would be fun. Let me know in the comments below. There is no end to the data that we have in terms of research we can do. A lot of these video ideas come from you guys. So if you want to compare the top 2050 funds, or you want to see which 2050 funds have the best long-term performance with the least volatility, things like that, I'm happy to experiment with. I could talk shop all day long, as you know. So I'll leave you there. I appreciate you guys watching. Have a great, great rest of your day. If I helped you in some way, maybe you'll hit the subscribe button. I do appreciate that. And yeah, we'll see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.